welcome to this training session. Today we are going to discuss and learn how to audit property, plant, and equipment through the performance of substantive testing procedures. I would like to stress that this training for property, plant, and equipment focuses solely on substantive testing procedures and assumes that the audit team did not conduct any tests of controls. Hello? Okay. Anyway, other training sessions will cover tests of controls and their effect on substantive testing. I would also like to emphasize that the nature, timing, and extent of these substantive audit procedures depend on the results of our risk assessment process, which starts during the planning phase of the audit. In this regard, it is possible that not all of the substantive procedures covered in this training session may need to be performed by the audit team, or that additional audit procedures not discussed here may be necessary to be performed to validate the account balances depending on the circumstances of our client. So it all depends on the results of our risk assessment process during the planning phase. But having said that, let's start the session with the training objectives for today. At the end of this training, I hope that you would have gained a basic understanding of property, plant, and equipment, learned about some of the common risks relating to property, plant, and equipment, learned the principal audit objectives in auditing property, plant, and equipment, and finally, learned about the substantive audit procedures typically performed on property, plant, and equipment. This training will be conducted in the same order as these training objectives. So, what is property, plant, and equipment? Property, plant, and equipment are non-current physical or tangible assets that are expected to generate long-term future economic benefits for a company or organization. They are also more commonly known as fixed assets because they are not easy to liquidate and be converted into cash. Some call them PPE for brevity. Yung mga tamad na sabihin yung long account name na property, plant, and equipment, tinatawag na lang nila na PPE. Fixed assets are held for use in the production or supply of goods and services or administrative purposes. In other words, fixed assets are assets that are not sold or consumed by a company. Rather, they are used to produce goods and services. Fixed assets also have estimated useful lives of more than 1 year since they are expected to be used during more than one period. So if an asset has less than an estimated life of, or if an asset has an estimated life of less than 1 year, you cannot classify it as fixed assets kahit na yung use niya is similar to a fixed asset. Under PAS 16 of the Philippine Financial Reporting Standards or PFRS, PPEs are initially measured at cost, and then after recognition, companies can choose to measure fixed assets either at the cost model or the revaluation model. Under the cost model, fixed assets are carried at cost less accumulated depreciation and impairment losses. Depreciation is a systematic reduction in the value of the fixed assets based on their estimated useful lives due to their use and wear and tear. Impairment losses, on the other hand, pertain to the excess of the carrying value of the fixed assets over their recoverable value. The revaluation model, on the other hand, can be used when the fair value of the fixed assets can be measured reliably. Under this model, the fixed assets are carried at the revalued amount, less accumulated depreciation and accumulated impairment losses. The revaluation model, fixed assets are presented under the non-current assets section of the Statement of Financial Position. Typical examples of fixed assets are land, building, machinery and equipment, computer equipment, furniture and fixtures, transportation equipment, and buildings or structures that are currently under construction, which are also known as construction in progress. All fixed assets are subject to depreciation and amortization, except for land and construction in progress. So now that we have already an idea of what property, plant, and equipment are, let's now move on to discussing the common risks associated to the account. What makes fixed assets vulnerable to financial statement misstatement? Fixed assets often represent one of the largest, if not the largest accounts in the financial statements of many companies. Their accounting treatment, however, can range from being straightforward to a little bit complex depending in part on the accounting framework being used by the company. For example, under PFRS for SMEs and PFRS for SEs or small entities, property, plant, and equipment are recognized at the cost model only. So, at cost lang pwede. However, under full PFRS, fixed assets, aside from the cost model, can also be carried at the revaluation model, as we said earlier. The revaluation model requires the use of estimates and judgment in determining the fair value of the property, plant, and equipment. The same is true with depreciation and impairment losses. As we all know, estimation and judgment are inherently prone to error, and therefore, the risk of misstatement in fixed assets goes up when the fixed assets are carried at the revalued amount and when there are indications of impairment. In contrast, costs can be verified by examining documents such as invoices, purchase agreements, billing statements, collection receipts, etc. As I have just said, estimation and judgments are also used in determining whether impairment exists, and if it exists, how much the impairment loss is, what are the total useful lives of the fixed assets, and how much are the residual values of the fixed assets, if any. The useful lives of fixed assets and residual values pose lesser risk in the Philippine setting because most companies have here actually do not make use of residual values anymore, since it is more often than not that companies continue to use their fixed assets up to the very end of their usefulness. Many companies continue to use their fixed assets even after their full depreciation. It is only when the fixed assets really cannot be repaired and used anymore that companies tend to write them off from their books or dispose of them for very minimal amounts. As to the useful lives, it is somewhat easier to assess their reasonableness because there are typically available data to compare the useful lives of the fixed assets with. What I
Galing
mean to
nila
say
dyan, no?
is
Tingnan mo
the
si Papa.
average useful lives being used by the companies for, say, computer equipment, furniture and fixtures, vehicles, etc., can easily be found. Just check the internet and you'll find them. Even the tax code has prescribed the useful life for certain fixed assets, such as those used in the production of petroleum, for example. The useful lives of these assets, according to the BIR, should range from 5 years to 10 years. So what I am saying is, if we try hard enough, we really can independently assess the reasonableness of the useful lives of the useful lives our client uses to depreciate their fixed assets. So as far as the useful lives is concerned, hindi masyadong mahirap i-assess kung yung reasonableness. This therefore leaves impairment losses, and fair value to be the estimation and judgment amounts that are difficult to evaluate. However, it's not often that companies use the revaluation model in recording their fixed assets because this model costs money. Mahal mag recognize ng fixed assets um, at revaluation, at appraised values. To get the fair value of their fixed assets, companies typically engage the services of professional property appraisers. And the services of these appraisers do not come cheap. Remember, companies that opted to use the revaluation model have to engage the services of these appraisers more than once because revaluing of the fixed assets cannot be done only once. PAS 16 requires that revaluation be made on a sufficiently regularity to ensure that the carrying amount of the revalued fixed assets does not differ materially from the fair value at the end of the reporting period. So just imagine the additional cost these companies incur to determine the fair value of their fixed assets. Accordingly, unless deemed necessary by a company, fixed assets are generally carried at the cost model here in the Philippines. As to impairment, the accounting standards require that the recoverable amount of fixed assets be measured whenever there is an indication that the asset may be impaired. Accordingly, if there are no indications of impairment noted, then impairment estimation is not required. This is especially true for those companies using full PFRS. Theft, although still possible for movable or portable fixed assets, is not as often committed as those for inventories and cash. This information, plus the matters we just discussed, makes the inherent risk for fixed assets to be typical in the vicinity of low to moderate risk only. Bihirang maging high risk ang fixed assets. As I just mentioned, fixed assets are rarely physically stolen because, let's be honest, how do you physically steal a building or a parcel of land? Paano ba nanakawin yon? Do people or entities even attempt to steal fixed assets just like they do for inventories or cash? Well, the operating word here is physical. So physical stealing. Fixed assets may be difficult or even impossible for some items to be physically stolen, but they can be stolen through documents such as forging signature and faking sale agreements. I am sure that you have heard and watched this scene on news and movies where an individual presents a stolen credit card, fake ID, and or uses fake names or a name of another individual to buy a car or expensive equipment. So, but not many get into this kind of fraudulent activity, at least not within a company. What is usually done is that fraud or misstatement in fixed assets is committed within a company through their recordings in the book. Accordingly, while fixed assets are not typically subjected to theft, there are still a few common risks associated with the account, which we shall discuss briefly. And these are the common risks we will discuss. Unreasonable use of estimates resulting in an incorrect valuation of fixed assets. Non-capitalizable amounts are capitalized and vice versa. Stealing of portable and movable fixed assets. I would like to point out that this list is not all inclusive, and therefore other risks on fixed assets may arise depending on the circumstances of your clients. The risk on fixed assets that we will discuss first is the unreasonable use of estimates resulting in an incorrect valuation of fixed assets. This is the most common source of misstatement or error in fixed assets. As we have said earlier, The valuation of fixed assets is affected by many factors that involve estimation and judgments, such as the useful life, the residual values, the impairment losses, and the fair value of the fixed assets. Accordingly, the errors or misstatements in fixed assets are typically caused by any of these factors. Some of the widely reported accounting scandals involving fixed assets relates to depreciation. Since depreciation is computed based on management's discretion, such as the type of depreciation method used and the estimated useful lives used, companies can perpetrate fraud by misrepresenting and misstating the carrying value of fixed assets. As we all know, depreciation directly affects the total assets presented on the statement of financial position, the net profit presented on the statement of income, and the shareholders' equity through retained earnings. Lower depreciation results in higher net profit, which in turn results in higher shareholders' equity balance. Accordingly, a company that wants to show a higher book value to their stakeholders may intentionally present lower depreciation expense than what is reasonable, or they may commit this type of fraud to meet target earnings. This is exactly what the US SEC found a comprehensive waste management company was allegedly doing in 1998. The company lowered its depreciation expense by assigning inflated residual values and extending the useful lives of its garbage trucks. It also did not record impairment losses when the value of their landfills decreased. This led to an overstated valuation of the fixed assets. The next common risk that we will discuss is non-capitalizable amounts are capitalized and vice versa. Whether intentionally or unintentionally, overstatement or understatement in fixed assets can occur from improper accounting of costs. For example, cost of opening a new facility or administrative costs cannot be included in the cost of fixed assets, while expenses such as import duties should form part of their cost. As auditors, we need to know which costs are capitalizable and which are not. The last risk associated with fixed assets that we will discuss before we move on to audit objectives is the physical stealing of portable and movable fixed assets. While it may be hard to steal buildings, land, and other large machinery and equipment, some portable or movable fixed assets like computer hardware, small furniture and fixtures, and similar items can still be subject to theft also. I'm sure you've also seen those videos where thieves steal ATMs which are supposed to be not movable at all. In other words, nothing can deter a determined thief. So auditors must still exercise professional skepticism when it comes to the misappropriation of fixed assets. So let's now move on to the audit objectives. The property, plant, and equipment account, as we have said, is one of those accounts that usually show the largest balances in the statement of financial position. However, even though the balance of fixed assets may be high enough to assess the risk of material misstatement to be high because of the large amount, such risk is typically mitigated by other factors that may eventually lead to an overall low or moderate risk assessment on the fixed assets account. These mitigating factors include, among others, the nature, physical size, and even the accounting treatment of the account. For example, the cost of fixed assets do not move as often as, say, inventories or receivables because acquisitions and disposals of these assets are not done regularly. Furthermore, fixed assets, due to their physical size and nature, are harder to steal. Finally, the accounting treatment for property, plant, and equipment, especially those accounted for under the cost model, is generally considered not difficult. With this information in mind, let's briefly discuss the principal objectives in auditing property, plant, and equipment. We have 5 principal objectives in auditing property, plant, and equipment. These audit objectives aim to address the different risk assertions we have to be alert for during the course of our audit. Let's briefly discuss each of these objectives, starting with the first one, which addresses the assertion of existence. So the first audit objective is to ascertain that all property, plant, and equipment on the balance sheet, including those assets under capital leases, are held by the entity or by others for the entity. The existence of property, plant, and equipment is typically an issue that many fixed assets-intensive companies face. These companies are usually those large ones that require tremendous amount of fixed assets to operate. For example, manufacturing companies, construction companies, and even large accounting firms that provide each of their employees in the operation and administration departments a laptop or a computer to use. Just imagine a large professional firm with more than 1,000 laptops to account for and replace every, say, 3 years to keep up with the technology, with the technology. Aside from a large number of laptops and the frequency of replacing such laptops, these computers can also transfer from one employee to another employee or from one division to another division of the professional firm. Accordingly, if the professional firm does not have strong internal controls in place to monitor all the laptops, including their record keeping, then some laptops may get lost or improperly recorded without the management noticing the same. The same is true for other companies which are required to maintain tremendous amounts of fixed assets. Fixed assets may no longer be existing and yet are still recorded in the books of the company because of its weak controls over the monitoring and recording of such assets. The audit procedures that will be designed and performed by auditors should therefore be able to address the existence assertion. The next principal audit objective we will discuss is the objective to ascertain that all property, plant, and equipment owned or leased under capital leases by the entity at the balance sheet date are included on the balance sheet. This audit objective aims to address the completeness and cut-off assertion. You may think that companies would always ensure that all their fixed assets are recorded in their books, not only because it is the right thing to do, but also to improve their financial position. After all, the carrying value of fixed assets increases the amount of total assets balance of the company, and more total assets generally indicate good financial health. However, the key word here is carrying value. Fixed assets are subject to depreciation and impairment losses, excuse me, which are charged to profit or loss statement. Accordingly, an erring company may intentionally not record certain acquired fixed assets to avoid the related depreciation expense or impairment losses. Excuse me. Another audit objective is to ascertain that property, plant, and equipment are carried at the appropriate amount, taking into account the accumulated depreciation, depletion, amortization, or impairment losses. Three factors can misstate the carrying value of property, plant, and equipment. These are cost, accumulated depreciation, and accumulated impairment losses. If the company chooses to carry its fixed assets under the revaluation model, then a fourth factor, which is the fair value, can also misstate the value of the fixed assets. An error or misstatement in any of these factors, cost or fair value, accumulated depreciation, and accumulated impairment losses, will result in error or misstatement in the carrying balance of the fixed assets account. Accordingly, the audit procedures that will be performed on the account should be able to ensure or ascertain that the cost or fair value of the fixed assets, including the related accumulated depreciation and impairment losses, are correct following the provisions of the accounting framework the company uses. The fourth audit objective is to ascertain or to determine that the entity owns or has a legal right to all the property, plant, and equipment on the balance sheet at the balance sheet date. Fixed assets owned by others, such as those of related parties, or purchased fixed assets, the control or ownership of which has not transferred yet to the company as of the cutoff date, should not be recorded as such on the statement of financial position. Accordingly, the audit procedures that we will perform on fixed assets should be able to ensure or ascertain that only fixed assets owned by the company or that the company has legal rights to are recorded in the books as property, plant, and equipment. Finally, the last audit objective we will discuss is to ascertain that property, plant, and equipment and related accounts are properly classified, described, and disclosed in the financial statements, including notes in conformity with prescribed accounting principles. Accounting standards require that property, plant, and equipment are properly described and classified on the statement of financial position. The accounting standards also require a lot of information about the fixed assets to be disclosed in the financial statements. This information includes, among many others, the measurement basis used for determining the gross carrying amount, the depreciation method utilized by the company, and the estimated useful lives in depreciating the assets. In this regard, the audit procedures designed for and performed on the account should be able to ensure that the fixed assets are properly described, classified, and disclosed in the financial statements following the requirements of PAS 16 or other relevant accounting standards used by the company. So now, after discussing the audit objectives, we will now move on to the substantive audit procedures, which is our main topic. We have reached the point of our session where we'll go through the typical substantive audit procedures for fixed assets. It should be noted that not all audit procedures relating to fixed assets will be covered in this training. Only some of the typical procedures will be discussed. This is because substantive audit procedures are not the same for all clients. The timing and extent of the audit procedures will not be covered here since these matters are determined based on the results of our risk assessment process. Also, it is possible that some of these procedures may not need to be performed on your client at all. In the same breath, additional procedures not discussed here may need to be performed on your client because the audit procedures must be customized for each client depending on the results of the planning activities performed by the audit team. Now and then, I think it is necessary to emphasize that every audit engagement should have an audit program. An audit program is a list of audit procedures that needs to be performed by the audit team for the proper execution of the audit. Every audit program should be customized based on the results of the procedures. For a junior staff, ensure that you have the audit program in front of you before starting an audit, because the same will be our guide in performing the audit procedures. Audit programs are generally or typically customized by the senior of the engagement, should be thoroughly reviewed by the team manager, and should be approved by the engagement partner and concurring partner if applicable. So let's move on to discussing the typical substantive audit procedures performed on fixed assets. The first step we will discuss in auditing fixed assets is to obtain or prepare a detailed roll-forward summary of the cost of property, plant, and equipment and related accumulated depreciation by major classification. Please note that this is not necessarily the first audit procedure that we do for fixed assets. This is just the first audit procedure that we will discuss. The first audit procedure that we should be doing is to prepare a lead schedule or a summary of fixed asset balances by major classification, where the current year balances can be compared directly with the prior year balances, and where adjusting entries for fixed assets, if any, will be posted later. But going back to the roll forward analysis, ensure that we have this analysis for fixed assets because it will not only facilitate the audit, but this summary is a required disclosure in the financial statements. So we will be hitting two birds in one stone if we will start our audit, other than the lead schedule, of course, with this summary. This is an example of a roll forward analysis of property, plant, and equipment. As we can see, the roll forward analysis should be divided into cost, accumulated depreciation, and net book value. Please note that when there are accumulated impairment losses recognized by the company, then another table under accumulated depreciation should be presented to account for the movement of the accumulated impairment losses as well. However, for these training purposes, we will assume that there was no indication of impairment of fixed assets noted as yet. Hence, only depreciation was recognized by the company for its fixed assets. As we can also see in this example, the roll-forward analysis is meant to account for the movements of the cost of the fixed assets by major classification and the related accumulated depreciation during the year. The analysis starts with the beginning balances of both cost and accumulated depreciation, followed by additions and disposals during the year, and ending with the balances as of the cutoff date of cost and accumulated depreciation, as well as the net book value of the fixed assets by classification. This type of roll-forward analysis for fixed assets can be obtained from the client or can be prepared by us ourselves if we have already with us the necessary information to prepare this type of analysis. For instance, if the client provided us a copy of their fixed assets register, then we can most likely prepare this analysis ourselves. However, it is always preferred, remember, it is always preferred that the company prepare this themselves for our verification only. Mas maganda kung yung client talaga mag-pre-prepare ng roll forward for us. Please note that when preparing or verifying this type of analysis, we should ascertain that the additions presented during the year to accumulated depreciation equal the depreciation expense on fixed assets charged to the profit or loss statement. Any material discrepancy should be investigated since such discrepancy affects the cash flows computation of the company, among others. This is if the roll forward analysis was prepared by the client, the easiest way or one of the easiest ways to check kung tama yung roll forward analysis is to check on the depreciation kaagad. I-check lang natin kung nagta-tie up yung depreciation presented on the roll forward analysis with the depreciation expense na recorded sa trial balance or sa GL. Pag nag-tie up siya, then we can continue with using the roll forward analysis kasi most likely tama siya. Pag may difference, then dapat medyo magkaroon tayo ng konting pagdududa kung tama or mali yung pag nagawang roll forward analysis ng kliyente. When it is the client who prepared this roll forward analysis, please ensure to check for the clerical or mathematical accuracy of the analysis and to ascertain that the ending balances of cost and accumulated depreciation agree with the general ledger balances as well as the fixed assets register of the company. A fixed assets register is the subsidiary ledger used for fixed assets. Any discrepancy between the roll forward analysis and the general ledger and or the fixed assets register should be investigated as well. Also for recurring clients, no procedures are needed to be performed on the beginning balances anymore other than tracing them to the prior year's audited balance in our work papers. They should be the same. If there are differences noted in the beginning balances between the rolled forward summary and the audited balances for prior year work papers or audited financial statements, such differences should be elevated immediately to the client for reconciliation as well. Also, we might find from time to time that on top of the captions, additions, and disposals, the client would show captions such as reclassifications or adjustments in the roll forward analysis that they prepared. When this happens, ensure that we gain an understanding of the nature of these reclassifications and or adjustment amounts. We should also ascertain whether these reclassifications and or adjustments were properly presented and accounted for in the roll forward analysis because it is not typical for a roll forward analysis to have these reclassifications or adjustments. So make sure that when you see these captions in the roll forward analysis that the company prepared for us, make sure to look into those reclassifications or adjustments immediately. Or make sure to take a look at those reclassifications or adjustments. Let's now move on to the second step, which is to examine supporting documents such as purchase contracts, paychecks, vendors' invoices for asset additions that meet the testing scope in order to verify the recorded cost. Once we have ascertained that the beginning balances presented on the roll forward analysis agree with the previous year's audited balances and that the ending balances presented on the analysis are all tied up with the general ledger balances, then we can now move on to verifying the current year movements presented on the roll forward analysis, starting with the current year additions to cost, or in other words, the acquisitions made by the company during the year. When there are several acquisitions made during the year, we don't need to perform procedures on all such acquisitions. Testing of key items and or samples will typically be sufficient. Please note, however, that selecting the items for testing should be guided by the performance materiality and testing scope that were predetermined and set by the engagement audit team. For this training session, we will refer to the performance materiality as tolerable error or TE. So using the roll forward analysis presented earlier, we can see that the TE was set by the audit team at 300,000 pesos with the testing scope set at 1/3 of TE. This means that only amounts equal or greater than 100,000 pesos, which is computed as 300,000 multiplied by one-third, will be examined for supporting documents. For those not familiar with these terms, tolerable error or TE is a term among others used by auditors to identify the accounts or transactions for which substantive procedures will be performed. The testing scope, which is usually lower than the amount of TE, determines the individual transactions that will be tested for evidence. In other words, TE and testing scope are thresholds that auditors use in identifying the accounts and transactions that will be subject to auditing. Accordingly, if this is our first time, excuse me, to audit a client, make sure that we familiarize ourselves, among others, with these terms and the related predetermined amounts before performing any testing procedures on the account balance that we have been assigned to audit. Dapat alam natin to before we even go to the client actually. Anyway, going back to the roll forward analysis, only machinery, equipment, transportation equipment, and construction in progress met the TE amount of 300,000. Transportation equipment showed additions amounting to 520,789 pesos, while construction in progress showed additions amounting to 590,865 pesos. These are both above the TE amounts of 300,000 pesos. No machinery was acquired in the current year. Therefore, we should request the client for the breakdown of the additions to transportation equipment and construction in progress only. There is no need to ask for the details of the additions to furniture and fixtures and computer equipment accounts since they were both below the TE amount. Please note that we can also identify the additions for testing based on the fixed assets register of the company. Just ensure that the roll forward analysis agrees with the fixed assets register as we have discussed previously. Let's see if you understood this particular procedure correctly. Let's review together this audit case about fixed asset addition. Once the breakdown of additions has been provided to us, don't forget to scan first the additions for unusual items. If nothing seems to be out of the ordinary, then select those that will fall in the testing scope set earlier by the audit team. So let's say, for example, that the client provided us with the following details of transportation equipment and construction in progress. This means that we will examine the costs that met the testing scope. These are the acquisitions that are equal to or more than 100,000 pesos. So we will request the client to provide us a document supporting the Vigo car for 520,789 pesos, cement for 125,786 pesos, lumber for 111,567 pesos, and the construction service fees for 200,000 pesos. These four additions to property, plant, and equipment, which totaled 958,142 pesos already, comprise 83% and 86% of the combined transportation equipment and construction in progress addition totals and fixed asset addition total respectively. For these selected additions for testing, we should examine supporting and sufficient documents such as vendor invoices, billing statements, official receipts, purchase contracts, and similar documents to verify the propriety of their recorded cost. We should also ensure that the costs recorded in the books do not include non-capitalizable costs or that capitalizable costs such as import duties are included in the cost. We are going to audit the acquisitions made during the year. We were given a complete list of the additions made to property and equipment. Based on the agreed team plan, any addition greater than one-third of TE will be examined for supporting documents. So the TE set for the client is 300,000. Following are the additions to the fixed assets of the client. The first acquisition presented on the list was asset number 10004, representing one unit of Toyota Innova acquired on July 15, 20 CY for 944,678 pesos. The second acquisition presented on the list was asset number 31007, representing two sets of computers acquired on April 15, 20 CY for 110,675 pesos. The third acquisition presented on the list was asset number 31011, representing desks and chairs acquired on June 12, 20 CY for 22,508. The fourth acquisition presented on the list was asset number 31019, representing filing cabinets acquired on July 2, 20 CY for 24,980. The fifth and the last acquisition presented on the list was asset number 31076, representing split-type air conditioner acquired on November 17, 20 CY for 30,069 pesos. Here are the questions we need to answer about those acquisitions. Question number 1. Which of the additions should we ask supporting documents for? And question number 2. For the Toyota Innova, the client provided us with several documents and told us that all the amounts on the supporting documents were included in the cost of the car amounting to 944,678. These documents include the following. So these are the components of the Innova cost. An invoice for 957,678 pesos that shows a discount of 30,000 pesos, registration documents for 10,000 pesos, and interest billing statement from Toyota for 7,000 pesos. So the second question is, was the Toyota Innova's acquisition cost properly recorded in the books of the company? All right, let's review our answers. For question number 1, which of the additions will you ask for supporting documents? The testing scope, as set by the team for this case, was computed as the TE of 300,000 pesos multiplied by 1/3 or 100,000 pesos. So that is the testing scope. This means that all acquisitions equal to or more than 100,000 pesos will be selected for testing. Therefore, the answer to the question is, you should request the client for documents supporting obviously the Toyota Innova and the two sets of computers since they met the 1/3 of TE criteria set by the team. These are the only acquisitions that exceeded the 100,000 threshold. The other acquisitions during the year were all below the 100,000 pesos testing scope. Hence, no further procedure will need to be performed on them. Furthermore, if added up, the total acquisition of property and equipment made during the year amounted to 1,132,910 pesos already. In this regard, the cost of the newly acquired Toyota Innova and the two sets of computers alone comprise about 93% already of the total acquisition cost, thus further indicating that no other acquisitions are needed to be selected for testing anymore, since the untested population was not significant anymore as to affect the fairness of the total acquisition cost. For question number 2, was the Toyota Innova's acquisition cost properly recorded in the books of the company? The answer is actually no, because the interest expense should be excluded from the cost of the car. However, should the amount of 7,000 be considered trivial by your audit team, such amount may be passed already for adjustment by the audit team. So since maliit lang naman yung amount, pwede na siyang i-pass. That is, kung considered siya as trivial based on the predetermined materiality level of the audit team. Before passing it, however, check and discuss first with the client whether they want to take up the adjustment in their books themselves. If they agreed to adjust the acquisition cost of the Toyota Innova, ensure to ask for the journal entries made for the removal of both the capitalized finance cost of 7,000 pesos and the related accumulated depreciation. So it shouldn't be, if they agreed to remove the 7,000 from the cost of the vehicle, make sure to get the entry not only for the removal of the cost, but for the removal of the related accumulated depreciation, also related to that 7,000 pesos. But should the client choose and insist to retain the amount of 7,000 pesos as part of the acquisition cost, we have two choices. One, pass the error for adjustment, meaning no proposed adjustment will be made if the amount is considered trivial based on the materiality level set by your audit team, or carry the amount to the summary of uncorrected misstatements for further evaluation as to their impact on the financial statements. And so once we are satisfied with the additions to fixed assets, once we are satisfied that the additions to fixed assets are valid and properly recorded in the books, we can now move on to the next items on the roll forward analysis, which are the fixed assets disposed of during the year. So for selected asset retirements and dispositions, examine supporting documents to verify proceeds and determine that the appropriate cost and accumulated depreciation were removed from the accounting records. We should also recompute the gain or loss if they are material. In this case, the disposed asset, which had a zero net book value, had a cost of 20,678 pesos only. Given the TE of 300,000 pesos and testing scope of 100,000 pesos, there's no need to perform an audit procedure on this disposal anymore. However, if there's an unusual movement in gain or loss on disposal of fixed assets charged to profit or loss concerning this particular disposal, then we should consider performing audit procedures as well. Let's say the company recorded a gain on disposal on fixed assets amounting to 256,786 pesos. Although this gain on disposal is below the TE amount of 300,000 pesos, we should still consider verifying this amount, since it is unusual for a fully depreciated asset with an original cost of only 20,678 pesos to be sold for a gain of 256,786 pesos. It could be possible that there was an error or misstatement in the recorded amount of gain on disposal of fixed assets or in the recorded fixed assets themselves. In other words, auditors should not consider the performance materiality level as an infallible threshold in performing audit procedures. Noted unusual items, although below the materiality level, may still need to be examined because such items may uncover significant errors, misstatements, or even fraud in the account balances. Professional judgment, therefore, should be exercised by auditors when to examine amounts that are below the set performance materiality level. For material disposals or retirements of assets, for example, because in this case, the disposed assets is not material, but when there are material assets disposed during the year, we should examine supporting documents such as sales agreements, official receipts, and other similar documents to verify the occurrence of the sale and the sales price. We should also recalculate the related gain or loss on sale, including the taxes due if any. Any material exceptions in the performance of this procedure should be discussed with the client, and necessary audit adjustments should be proposed or taken up by the client. So let's move on to the next substantive audit procedure. I would like to emphasize that aside from checking the disposals, we should always perform the procedure, which is to ensure that the amount of cost and accumulated depreciation associated with the disposed assets is properly removed by the client from both the fixed assets register and the general ledger. There have been times in the past where a company recorded directly the disposals only in the general ledger but not on the subsidiary ledger or fixed assets register. This resulted in perpetual discrepancies between the fixed assets register and the general ledger balances, and na-reconcile lang siya until na-remove yung the disposed assets from the fixed assets register. So before we leave the recorded cost of property, plant, and equipment, so that's how those are the procedures we perform on the cost of fixed assets. But before we leave the recorded cost of PPE, we should also perform the next audit procedure, which is to support or examine support for material charges to repairs and maintenance expense account to determine any potential items that should have been capitalized. To ensure that all fixed assets are completely recorded, or to ascertain whether all capitalizable costs are included in the fixed assets cost, we also examine the repairs and maintenance account. To do this, we typically request the client for an analysis of the repairs and maintenance account. We then scan such analysis to note for material charges and unusual charges to the account. PAS 16 provides that the cost of fixed assets comprise the purchase price, including import duties and non-refundable purchase taxes, net of trade discounts and rebates, and any cost attributable to bringing the fixed assets to the location and condition necessary for it to be capable of operating in the manner intended by management. And another factor is the initial estimate of the cost of dismantling and removing the item and restoring the site on which it is located. The standard provided examples of directly attributable costs that are capitalizable to the cost of fixed assets. For repairs and maintenance, the general criteria of capitalization typically applies. The general criterion is that there should be an additional probable future economic benefit that will flow to the company from the subsequent expenditure to be recognized as an asset. The decision on whether the subsequent expenditure is capitalizable or not depends on whether the existing part of the fixed asset was replaced or whether the subsequent expenditure adds a new element or functionality to the fixed asset. The standard provided the proper accounting treatment for replacement cost. We all know that repairs and maintenance should be charged to profit or loss. So why do we need to review repairs and maintenance, and why do we have to know the accounting rules on what cost should form part of fixed assets and which cost should be expensed? It is because, as we may have not noticed, there are so many rules regarding fixed asset expenditures that some companies fail to properly recognize and record expenditures that should form part of the fixed assets cost. And one of the accounts that is typically charged for any fixed asset related expenditures is the repairs and maintenance account. We may think that companies would rather capitalize expenditures and record them as part of an asset cost than charge them to profit or loss. After all, capitalizing costs essentially reduces expenses, thereby improving the company's results of operation. Consequently, the risk of capitalizable costs charged to repairs and maintenance should be very low, right? Well, it depends on the motivation of the management. It could be that management has no intention of misstating repairs and maintenance account, and that any misstatement found in the account could just be a result of an error and weak accounting knowledge about capitalizable costs. Or it can also be possible that management intentionally charges to repairs and maintenance account certain capitalizable costs to say, for example, minimize the tax due from the company. In other words, the controls implemented by the company, as well as management intention, should be kept in mind by the auditors when reviewing the charges made to the repairs and maintenance account. Any material charge to repairs and maintenance account, therefore, should be verified for their proper accounting treatment by inspecting appropriate and sufficient documents supporting such expenditures. Any erroneously charged significant capitalizable cost noted should then be discussed with the client and also be proposed for adjustment to fixed assets costs, including their related depreciation. The next audit procedure we will discuss is to perform analytical review procedures or detailed recomputation to test depreciation or amortization expense. So we're done with the cost. We're now going to the accumulated depreciation side of auditing the account. Some of the widely reported accounting scandals relating to fixed assets in the United States involve the fraudulent recording of depreciation. Accounting frauds are not as widely reported in the Philippines as in the United States. So unfortunately, I could not readily cite similar cases here in the Philippines. Nevertheless, fraud is the same everywhere. In this regard, auditors should take precautions and be wary of possible fraud being committed in the calculation of depreciation. For depreciation, we typically perform analytical review procedures or perform recomputations to determine the reasonableness of depreciation expense for the year under review. An analytical review procedure, which involves comparing data, is an important activity since it can uncover error or misstatements on the account. For example, a drastic increase in the fixed asset costs, unaccompanied by a similar movement in depreciation, or even a decline in depreciation, may indicate an error or fraud in the recorded depreciation or even the cost. Accordingly, when we encounter unusual fluctuations like this, we should ensure to perform additional audit procedures on depreciation, such as recalculation. Recalculation or recomputation is when we perform an independent computation of the depreciation expense for the year. Please note that we do not test for the accuracy of the depreciation amount. Rather, we are only testing for the reasonableness of the amount. In this regard, the recalculation is more of a predictive testing rather than a real recalculation, and therefore we can use averages such as average useful lives or average depreciable cost. Here's a sample predictive testing of depreciation expense. As we may notice, we only took the averages of the depreciable cost for each fixed asset classification by adding the beginning and ending balances of the cost and dividing them by 2. Please note that it should be the depreciable cost and not just cost. This means that the cost to be used in testing should be net of those fully depreciated assets already. The average depreciable costs are then subjected to the depreciation recalculation. In this case, it is assumed that the client has no fully depreciated assets and uses the straight line method in computing for the depreciation. Accordingly, to perform the testing, we just took the averages of the costs recorded in the books that we have already verified previously and divided such average depreciable cost by the estimated useful life of each fixed asset classification. Because we only use averages, differences between the amounts of depreciation per books and the amounts per predictive testing are bound to happen. In this regard, we look for significant differences only. In this example, there were no significant differences noted for furniture and fixtures and computer equipment, which showed differences of 2,700 pesos and 1,315 pesos respectively only. Both these amounts are below our de minimis or summary of audit difference threshold of 9,200 pesos. Accordingly, we can conclude already that the depreciation expense for furniture and fixtures and computer equipment are reasonable and no further investigation or audit procedure needs to be additionally performed on them. However, such is not the case for machinery and equipment, machinery and transportation equipment. The depreciation for these two major fixed asset classifications showed significant variances for, sorry, the depreciation for these two major fixed asset classifications showed significant variances. The variance for machinery amounted to 539,344 pesos, while the variance for the transportation equipment amount to 52,079 pesos. Both of these variances are above our SAD threshold of 9,200 pesos. Hence, we need to investigate the nature of the variances. For machinery for which no additions were made during the year, it is obvious that the company recognized depreciation equivalent to 6 months only. For transportation equipment, we should investigate further the nature of the difference because there does not seem an apparent or obvious answer to the difference yet. Based on our tests of additions, we knew that there was only one acquisition of a Vigo car on January 3, 20CY. Accordingly, depreciation of this new acquisition for 20CY would be equivalent to a full year already along with acquisitions from the prior years. Disregarding the averaging method, therefore, the depreciation for transportation equipment for 20CY should be 261,975 pesos, computed as the ending cost balance of 1,309,876 pesos divided by the useful life of 5 years. The depreciation for transportation equipment is therefore understated by 104,158 pesos, which is the difference between the should-be depreciation of 261,000 pesos and the depreciation per books of 157,817 pesos. We should therefore be proposing an adjusting entry to increase the depreciation for machinery and transportation equipment for 539,344 pesos and 104,158 pesos respectively. Please note that we propose adjustments for the actual amount of error or misstatement in depreciation and not for the variance arising from predictive testing. I would like to point out at this point, however, that we should not only be doing mechanical recalculation or predictive testing of depreciation. We should also challenge the components needed to compute for depreciation. For example, we should also challenge the reasonableness of the useful lives or the residual values being used by the client. As we have mentioned earlier, some of the widely reported accounting scandals that involve property, plant, and equipment revolve mostly on depreciation because of the estimation factor affecting this account. For example, to meet its target earnings in 1998, a big waste management company in the United States allegedly decreased its depreciation expense by assigning inflated residual values and extending the useful lives of its garbage trucks. Another widely reported accounting scandal involved a holding company which, through its subsidiaries, offers car rentals, among others. According to reports, among other accounting misconducts allegedly committed by the holding company is the extension of the holding period of its car fleet, thus lowering its depreciation expense. The company reportedly used the holding period of the car rental assets, as the estimated useful life of the assets. So you see, we must review the useful lives and even the depreciation method that are being used by our clients and to verify the reasonableness of the useful lives used or the depreciation method used by our clients. It would be useful for us, auditors, to compare our client's depreciation method and the useful lives it assigns to its fixed assets with other companies in the same industry. For example, if a client uses 10 years to depreciate a laptop, the auditor should challenge and discuss the reasonableness of such useful life because in practice and compared to other companies, a laptop is usually given a life of between 3 to 5 years only, with 5 years already considered a stretch due to fast changes in technology. Also, if management changes or wanted to change the depreciation method of the estimated useful lives being used, it is vital that we clearly understand the management reason for the change. We should always keep in mind the management's motivation. For example, is there pressure to meet earnings targets or targets to meet earning targets from investors, creditors, or other stakeholders? Based on our experience and knowledge of management's integrity, together with all significant controls in place within the company, do we believe management would likely pull off a fraud scheme, such as unreasonably extending the useful lives of fixed assets to reduce costs? Keeping a questioning mind as to the motivation of management can also assist us in part in assessing whether the changes in useful lives or depreciation method being used by the company is reasonable or not. The next audit procedure we will discuss is to determine the necessity, sorry, is to determine the necessity or adequacy of impairment losses, if any. PAS 16 requires that property, plant, and equipment be measured for possible impairment whenever there is an indication that the asset may be impaired. PFRS for SMEs, on the other hand, requires that assessment be done for any indication that an asset may be impaired at each reporting date. The next audit procedures we will discuss is to determine the necessity or adequacy of impairment losses, if any. PAS 16 requires that property, plant, and equipment be measured for possible impairment whenever there is an indication that the asset may be impaired. PFRS for SMEs, as I said earlier, requires that assessment be done for any indication that an asset may be impaired at each reporting date. So let's take, for example, a diversified company that has three divisions: food, clothing, and feeds. If we become aware of continuous huge losses incurred by the feeds division and also become aware that the company may no longer be able to compete strongly in the feeds market in the coming years due to fast changing technology, then we should, if the company has not done yet, request the company to determine any possible impairment losses on the fixed assets being used in the feeds division. Note that because estimates are factored in calculating for impairment losses, regarding fair value and value in use, the staff assigned to assess the reasonableness of the impairment loss calculation made by the client must have the appropriate level of skills, competence, and experience to effectively execute the procedure. A junior staff with limited experience may not be capable yet of discerning an event that could indicate impairment. If indicators of impairment were noted and the client has not recognized any, the auditor must discuss the matter with the client immediately and request for the calculation and recognition of impairment losses when deemed necessary. Erring companies had been known to use impairment losses either by understating it or not recording it at all to improve their results of operation. Hence, we should be wary of this matter regarding auditing fixed assets. Before we move on to the last substantive audit procedure, we will discuss in this trainings before we move on to the last substantive audit procedure, we will discuss in this training session, and to help us understand more about the impairment losses, let's take this audit case. The client, a poultry company, told their auditor that they plan to stop tolling chickens after the audit of their financial statements had been done due to recurring losses from this revenue stream. The auditor then reviewed the minutes of meetings to substantiate the claim of the client and did not note any meeting agenda relating to the supposed planned stoppage of tolling. When reviewing the fixed assets, the auditor noted that tolling machines were just depreciated as usual and no impairment losses were considered nor recognized. Please note that for this audit case purposes, the company's tolling machines are used for defeathering chickens. Because of the result of the auditor's review of the minutes of meetings, which did not disclose any planned stoppage of tolling, the auditor deemed it appropriate not to follow up on the possible impairment of the tolling machines anymore. So the question is the auditor correct or not? My response to this is, the auditor is not correct. The recurring losses incurred by the company from the tolling revenue stream should be known to the auditors by now, and therefore a plan to stop the tolling operation may hold water after all. The recurring losses alone from tolling services should have alerted the auditor by now that a possible impairment of the tolling machines might be existing. The auditor should therefore have already considered verifying the possibility of impairment on property, plant, and equipment even without the claim of stopping the tolling operation in the future. The claim by the client of ceasing the tolling operation due to recurring losses should just be considered an icing on the cake for the auditor to start questioning for the impairment of the fixed assets used in generating tolling income. Accordingly, the auditor should perform further verifications of the claim made by the client. The auditor should request the client for the basis of their claim and from there further substantiate such claim. Possibly ask for other documents or consider inquiring from other appropriate personnel of the client who might know about the claim as well. Also also checked for subsequent events. Regardless of the results of these investigations, my opinion is the recurring losses from tolling services could be enough reason for the auditor to consider asking the client to evaluate the property and equipment associated with tolling services for impairment. The last but certainly not the least substantive audit procedure we will discuss is to ascertain that fixed assets are recorded properly following applicable accounting rules and that appropriate disclosure is made in the financial statements. The accounting standards require numerous information about property, plant, and equipment that need to be disclosed in the financial statements. For example, companies are required to disclose in their financial statements, among others, the measurement basis used by the company, the estimated useful lives used, the depreciation method, the movements in fixed assets from beginning balances to ending balances, and because fixed assets are usually used as collateral or securities to loans, the existence and carrying amounts of property, plant, and equipment that had been pledged as security or collateral are required to be disclosed as well. Most of the required disclosures on fixed assets will be encountered by us during our testing of fixed assets. However, for the existence of any pledged fixed assets, we need to review and read bank and debt confirmation replies, minutes of meetings, loan agreements, and other correspondences or documents for evidence of liens, pledges, security interests, and restrictions on fixed assets. Going back to the holding company case that we discussed earlier, the US SEC reportedly fined the company $16 million for allegedly filing inaccurate financial statements, including non-disclosure of the extension of the holding period of its car fleet. Because the company uses the holding period as the useful lives of its car fleet, the undisclosed extension not only resulted in lower depreciation unbeknown to its stakeholders, but also carried along with it the risk of using older cars that could require increased maintenance costs in the future. So as we can see in this case, ensuring that proper and appropriate disclosures are made on that ensuring that proper and appropriate disclosures are made on the financial statements is a very important audit procedure. And to end this training session, let's review together this audit case to learn more about auditing fixed assets. Assume that we have just been engaged to audit the current year's financial statements of ABC Limited, and as a result, we have been assigned to audit its property and equipment account. The planning materiality set by our audit team for the audit of the financial statements of ABC Limited was 645,000 pesos. The TE was set at 450,000 pesos, and the de minimis or trivial amount was set at 12,900 pesos, while the testing scope for the additions to fixed assets was set at 1/3 of TE. You were provided with a roll-forward analysis of the property, plant, and equipment account. The analysis showed that the company's fixed assets are composed of buildings, machinery and equipment, computer equipment, and furniture and fixtures. You also noted the following data on the analysis. At the end of the year, the carrying value of building, machinery and equipment, computer equipment, and furniture and fixtures amounted to these amounts: 34 million pesos, 5 million pesos, 431,000 pesos, and 376,000 pesos respectively, for a total carrying value of 40,807,023. Building, machinery and equipment, computer equipment, and furniture fixtures showed beginning cost balances of 60,890,656 pesos, 9,890,750 pesos, 567,984 pesos, and 489 pesos, 489,76,000 pesos, respectively, for a total beginning cost of 71,838,466. There were no acquisitions made during the year except for some computer equipment and furniture and fixtures. Accordingly, the cost of building and machinery and equipment did not change from their prior year's balances, while the cost of computer equipment and furniture and fixtures increased to 573,662 pesos and 498,865 pesos respectively. The total amount of depreciation expense recorded by the company for the year amounted to 3,477,553 pesos. The total accumulated depreciation recorded by the company for the year amounted to 31,046,910, and the useful life used by the company in depreciating the building account was 25 years, for machinery and equipment 10 years, for computer equipment 20 years, and furniture and fixtures also 20 years. As required by auditing standards, your audit team reviewed the work papers of the previous auditors of ABC Limited as of December 31 of last year. Unfortunately, however, the previous auditors were only able to present to your team a roll-forward analysis of property and equipment. The work papers showing the procedures performed by the previous auditors on fixed assets were not presented to your team for review. This is because, according to the previous auditors, their file archiving system unexpectedly malfunctioned and they were not able to completely recover all their archive files. For the property and equipment of ABC Limited, they were unfortunately only able to recover the roll-forward analysis and nothing else. However, the previous auditors informed your team that their previous audits of the fixed assets account did not uncover any material misstatement on the account, and therefore the previous auditors are confident that the prior year's ending balances of fixed assets were fairly stated and therefore can be relied upon by your audit team. You informed the client that only a roll-forward analysis was provided by their previous auditors to your audit team for review. The client acknowledged this information and agreed with the assertion of their previous auditors that the beginning balances of property and equipment were correct. The client then took the opportunity to inform you that the machinery and equipment with a carrying value of 3,588,900 pesos were planned to be replaced with more technologically advanced machinery and equipment. They are, however, still using the asset until the replacement arrives. The client said that they are currently waiting for the board of directors to approve the replacement and disposal of the machinery and equipment. However, there's already a plan to look for a buyer or buyers for the machinery and equipment the following year. Because of this plan to dispose of the assets, the client informed you that you will be receiving a copy of the journal entry they are currently preparing to reclassify this machinery and equipment from, from property and equipment account to assets held for sale account. As to depreciation, you noted that there were no fully depreciated assets as of the beginning and end of the year. The additions were not depreciated yet since they were acquired during the second half of December already. The first question is there a need to perform procedures on the beginning balance or beginning balances? Question number 2, what procedures will be performed on the additions during the year? Question number 3, what procedures will you do on the information provided to you by the client about the machinery and equipment that will be replaced? And the last question is, using the estimated lives being used by the company to depreciate their fixed assets, You noted in your independent testing of the reasonableness of depreciation that the amounts of depreciation presented on the analysis are equivalent to 1-year depreciation for each fixed asset classification. In this regard, can you conclude already that the total depreciation expense during the year of 3,477,553 pesos is reasonable? Let's review the answers. For question number 1, is there a need to perform procedures on the beginning balances? Because you were not able to sufficiently verify the beginning balances of the fixed assets, then yes, you need to perform independent substantiation of such balances by inspecting documents for the cost and recalculating accumulated depreciation on a test basis. Verbal representation about the appropriateness of the beginning balances, especially if such balances are considered significant in your audit, cannot be deemed sufficient evidence to determine the propriety of those balances. For question number 2, what procedures will be performed on the additions during the year? The answer is none. The additions are all below the testing scope of the audit team. In this regard, an inspection of documents supporting the additions is not necessary to be performed anymore. Question number 3 is, what procedures will you do on the information provided to you by the client about the machinery and equipment that will be replaced? Under PFRS 5, non-current assets held for sale and discontinued operations, the following conditions must be met for an asset to be classified as held for sale. 1. Management is committed to a plan to sell. The asset is available for immediate sale. There's an active program to locate a buyer. The sale is highly probable within 12 months of classification as held for sale. The asset is being actively marketed for sale at a sales price that is reasonable relative to its fair value, and actions required to complete the plan indicate that it is unlikely that the plan will be significantly changed or withdrawn. It is therefore imperative that you can verify that the company complies with all these conditions before accepting that the reclassification entry being made by the client is correct. So, kailangan ma-meet niya muna lahat ng requirements for an asset to be recognized as assets held for sale. The last question is, using the estimated lives being used by the company to depreciate their fixed assets, you noted in your independent testing your independent testing of the reasonableness of depreciation that the amounts of depreciation presented on the analysis are equivalent to 1-year depreciation and for each depreciable fixed asset classification. So the question is, can you conclude already that the total depreciation expense during the year is reasonable? The answer is yes, given that there were no significant acquisitions made during the year. So actually, that should end our training for today. So unless you have questions, you can send me questions. You can ask me questions, and we can discuss the answers then today. You can I don't know, siguro by chat, or if you have any questions about auditing fixed assets. Sorry, yung voice ko naging raspy na. Any question about auditing fixed assets? Actually, medyo simple lang naman yung audit ng fixed assets, especially kung basta at cost lang yung recording ng clients natin at walang impairment losses, of course, walang indication of impairment losses. So, medyo straightforward ang pag-audit, but sabi ko nga, if the fixed assets are recognized at revalued amounts, then nagkakaroon ng konting complications because we have to, hindi natin tinatanggap basta-basta yung mga basis na ginagamit ng client for revaluation. So kung nagbigay siya ng appraisal report, hindi natin dapat tinatanggap basta-basta yung appraisal report as well. Dapat tinitingnan natin kung sino yung appraiser, yung capability, yung competence, yung integrity nung appraiser, dapat kino-consider din natin. So pag tingin natin yung appraiser is not, may masamang image sa industry, for example, then pwede natin actually na i-reject yung appraisal report. So we will ask the client again to revisit yung appraisal report or yung appraised values, to revisit the appraised values that they use in recognizing their fixed assets at the revalued model. So madali lang. In other words, hindi naman mahirap i-audit ang fixed assets. Okay, thank you very much, everyone. Okay, thank you very much, everyone.